As of 10:10 a.m. Eastern Time, shares of CLIK Holdings Limited, trading on the NASDAQ under the ticker CLIK, are priced at $10.02. That is a staggering move, up $3.81 on the session, representing a gain of over 61.35%. The stock gapped up significantly at the open, hitting a high of $10.80 on volume that has already exploded past 10.9 million shares. When you see a percentage gain like that, a 60 or 70% move in the first hour of trading, the immediate expectation is a world-changing announcement. You think of a positive drug trial, a massive government contract, or a takeover offer at a huge premium. The mind gravitates toward the kind of news that permanently alters a company's valuation. But with CLIK Holdings, that expectation, that simple, clean narrative, is not the full story. The reality is a far more complex and volatile mix of genuinely positive operational news colliding with a recent and critical mechanical change to the stock's very structure. This isn't the kind of move you see in Apple stock or even the more volatile Tesla stock. This is a microcap frenzy, and understanding why it's happening is essential for anyone even thinking about opening a position on their Robinhood app or SoFi Invest platform. Let's first establish the common ground, the narrative that everyone is seeing. The expectation is that CLIK is exploding because of its news, and the news is good. Just 3 days ago, on October 24th, the company announced its fiscal year 2025 results. For a small company, the numbers were impressive. Revenue increased by 89.3% year over year to HK $83.5 million. The company's core growth segments, nursing and logistics solutions, each saw growth of over 200%. This is the kind of headline that gets attention. This was layered on top of news from October 14th, about 2 weeks ago, that CLIK Holdings was successfully accredited as an approved service provider under the Hong Kong government's Community Care Service Voucher Scheme for the Elderly, or CCSV. The company itself described this as a blue ocean, estimating the total market for this program could reach HK $1.9 billion. So you have an 89% revenue growth headline, followed by a blue ocean government contract narrative. That's the expectation, a fast-growing small company hitting its stride. But that's where the reality check comes in. The deeper truth is that these positive catalysts are acting as an accelerant on a financial structure that was designed for explosive volatility. The real story, the one that separates a hopeful investor from an informed analyst, is what happened on October 7th, just 20 days ago. CLIK Holdings announced a 1-for-30 reverse share consolidation. This move, which took effect on October 10th, was done to regain compliance with NASDAQ's minimum bid price rule, a common tactic for stocks that have seen their value erode. But the consequence of this action is profound. Before the split, the company had over 34 million shares outstanding. After the 1-for-30 consolidation, the total number of shares is just 1.145 million. More importantly, the public float, the Class A shares available for trading, shrunk to a microscopic 818,353 shares. Now look at today's volume. 10.9 million shares have traded. That means the entire public float has changed hands more than 13 times over in the first hour of trading. This is not long-term Fidelity Wealth Management clients or Schwab Intelligent Portfolios rebalancing their positions. This is a classic textbook low-float squeeze. The positive news, the 89% revenue growth and the CCSV contract provided the spark, but the 1-for-30 reverse stock split provided the tinderbox. The stock structure is so tight that any significant buying interest, whether from retail traders using SoFi investing platforms or momentum-chasing funds, creates a massive air pocket. There simply aren't enough shares available to absorb the demand, causing the price to launch vertically. This is a trader's environment, not necessarily an investor's. So what is this company that's causing all this commotion? CLIK Holdings Limited is a Hong Kong-based firm that positions itself as a human resources and senior care solutions provider. It claims to use a proprietary AI-powered platform to connect clients with its talent pool, which it says numbers over 23,000 professionals. Its business is broken down into three main areas: professional solution services, like providing accountants or company secretaries; nursing solution services, its big growth driver focusing on the silver economy of Hong Kong's aging population; and logistics and other solution services, providing warehouse workers, promoters, etc. The IPO was only about a year ago, in October 2024. The story it tells is compelling. It's a technology-driven play on a critical demographic trend, aging population, and essential business needs, HR and logistics. This narrative is what draws people in. However, the filings tell a story that requires caution, the kind of due diligence that anyone using an individual brokerage account or looking for serious investment help must perform. Let's look at those fiscal 25 results again, this time going past the 89% revenue growth headline. While revenue was HK 83.5 million, the company reported a net loss of HK 7.9 million. Now, they were quick to point out this was influenced by a one-time non-cash share-based compensation expense of HK 11.1 million. This implies that operationally they might have been profitable, which is a significant positive. However, the recently filed 20F annual report paints a picture of high risk. First, customer concentration is a major flag. For the year ended June 30, 2025, the company's top 5 customers accounted for 42.2% of its total revenue. Losing even one of those customers would be a devastating blow. Second, and perhaps more critical, is cash flow. While they had a small operating cash flow inflow of USD 0.4 million in 2023, for the year ended June 30, 2025, that flipped to a significant operating cash flow outflow of USD 6.0 million. This company is burning cash and fast. That 6.0 million cash burn is set against a market cap that, even after today's 61% spike, is only around $10.4 million. This is a company operating on the edge. The 20F also highlights the regulatory and geopolitical risks tied to operating in Hong Kong and notes a dual-class share structure, Class A and Class B, which can entrench management and limit the rights of public shareholders. There was even news back in July about the company, quote, exploring a $100 million cryptocurrency treasury strategy involving Bitcoin and Solana, though the more recent October 14th press release toned that down considerably, saying they are, quote, still exploring feasibility with caution. This collection of red flags, cash burn, customer concentration, geopolitical risk, and crypto mentions, is not what you find in a stable blue-chip NVIDIA stock or Fidelity mutual funds. This creates an intense tension for the future outlook, a perfect split between expectation and reality. The bull case, the expectation, is that the CCSV government program is the catalyst that truly changes the business. With a potential 1.9 billion HK market, CLIK only needs a small fraction to justify a valuation many times its current $10 million cap. The bulls see the 89% revenue growth and 200% segment growth as proof that its AI-powered platform works and is scalable. They believe the non-cash charge is masking underlying profitability, and that the $6.0 million cash burn is a temporary investment in expansion that will pay off as they become a leader in Hong Kong's silver economy. For them, the 61% spike is just the beginning. I'd be curious to know what viewers think. Comment below if you believe CLIK's 89% revenue growth is sustainable, or if this is just a low-float trap. The bear case, the reality check, is that this is a company burning through its cash reserves with a high-risk, concentrated customer base. The bears see the 1-for-30 reverse stock split not as a fresh start, but as a last-ditch effort to stay listed. They see today's 61% spike as a purely technical volume-driven squeeze on a microscopic float, one that has no bearing on the company's fundamentals. They would argue that serious online investing requires looking past the 61% gain and focusing on the $6.0 million cash outflow. They would point out that traders using sophisticated platforms like interactive brokers are likely playing this for an intraday scalp, not building a long-term position. The risk of a future offering to raise more cash is extremely high, which could dilute the already tiny float and could send the price tumbling. So, as we wrap this up, let's look at where we are.